There are thousands and thousands of indicators to watch for. The Hindenburg Omen is simply just one in a list. On this channel, we look at hundreds of the most reliable and relevant indicators which help to give a broad understanding of what's actually going on so that people can make informed decisions. The markets are not pricing in any risk whatsoever, so when we see the maximum euphoria, there's usually a correction that follows. Already markets are a bit weak, but still 100% all in. It's a mess. You came here for the truth, so let me unveil that for you. We're going to start by talking about the Hindenburg Omen. The brief way to describe this, and by the way, I've covered it in many previous videos before, but essentially, we're looking at the probability of a stock market crash. That's what it highlights, okay? And like I said, it's one indicator of many. Just because this triggers, does that mean that there's going to be a drop? Does that mean there's going to be a collapse? No, but it's one of many. It happens to be very accurate. It doesn't tell you how much the stock market will crash by. It might be just a simple correction. It might be a collapse. It's all in the, when you think of it in the grand scheme of things. So today, I've got 38 tabs open. It's unbelievable, but I have to get through all of this, so no more ranting. Let's go. Jerome Powell was interviewed by the Wall Street Journal, and everybody was watching his words, and he was extremely careful, in fact, reading off a piece of paper several times to mention the exact same thing that he's been saying for years. Essentially, we're going to remain accommodative, the policy is going to be this and that, and blah, blah, blah. You know it all before, you've seen the quotes, it's the exact same thing every time, and of course, the reporters ask the same questions every time. Now, what they did talk about, a couple important things that people need to know right here is simply that, and by the way, I sat through this so that you didn't have to. That's why the Money GPS is key to watch, because I do all the boring stuff and you get the highlights. So what we're looking at here is essentially they argued that, look at the bond market, things are looking wacky. Are you going to do anything about it? Are you going to make any changes? Is there going to be any tapering? What's happening with the bond market? Do you even look at it? Is that part of the whole plan, and so on? So he said specifically, there will not be any changes to their, what they do in their buying. They're going to keep doing the 120 per month. They're going to keep everything, the maturity and all of that. So essentially saying there's no yield curve control coming. He said nothing will change until the foreseeable future. And that's a long time away. We're going to continue to be accommodative. We're going to continue to keep interest rates at what they call the lower bound, 0%. And they're going to do that. And that's it. Because of one indicator, he specifically said many times, because of one indicator like this in the bond market, the 10-year yield getting wacky, we're not going to change our stance. We're not going to be more accommodative, less accommodative, or so on. We're not going to move anything anyway. Okay, so that's what he said. I wanted to make that very clear. The markets are looking at each and every single action the Federal Reserve takes, but they're also looking at the forward guidance, even the interviews that Jerome Powell and his co-workers are going to be, suggesting and things. These are done specifically to move the market in a certain way. What happened, though, was that the markets tumbled down. They tumbled down because there wasn't enough money printing, apparently. They want more and more and more. They're freaked out that there's only $120 billion a month, and we're only, this is in quotes, only at 0% interest rates. They want more. There's still one tool left in the tool belt, and that is yield curve control. And we'll see if they end up having to pull that out, or they simply just start printing a heck of a lot more money. We'll see. This was back in 2013, but it shows you how far we have come. Fed's Fisher says, must watch yields but can't fear the markets. At the bottom, there's a quote, we cannot live in fear that, gee whiz, the market is going to be unhappy that we are not giving them more monetary cocaine. That was 2013, and now today, in 2021, oh my goodness, have things really changed? They love the cocaine. They love sniffing it. They love bathing in it. I mean, it's unbelievable, but that's the kind of world that this has now become, that they have to get more and more and more, and you become desensitized to it as time goes on. So you need even more. You need even more. That's why every single bailout continues to get larger, or it has less of an effect. So this is what's happening today, and it is very worrisome for the future. All right, Hindenburg, let's go. The NYSE came close to triggering a Hindenburg Omen on March 2nd. The other conditions being met, it needed to have seen more than 91 new highs and new lows. It only saw 89 new lows, pretty close. Read more about it if you click that link. And below that, you see the chart. It's just showing you historically, since around the financial crisis time frame up until the present, every time that has been triggered, how many signals involved there. And like I said, doesn't always mean there's going to be this major collapse after, but you can see how many events that happened in which there were, corrections, or worse, as you see it. Now, this just gives you a little bit of insight into that Hindenburg Omen, and you could look at this as well, breaking it down, the NYSE composite, and this goes back, funny enough, it triggered back in March, around March timeframe 2020. Is that, coincidence? Who knows? I mean, you decide what you want to believe, but it happens to be a very accurate indicator, and they just give you some other stats to see here as well if you want to check them out. And then we have the NASDAQ, showing you the Hindenburg Omen over time. And like I said, same situation, March 2020, that was triggered. We're around that time frame now, and we'll see. The NASDAQ has really come off its highs. Certain stocks, I think I have pulled it up here, like Tesla, are way off their highs. So we'll see what happens here in the near term. It's not just QE that the markets are looking for. They're looking for stimulus, the stimulus checks. As you can see right here, U.S. retail investors plan to put a significant chunk of any forthcoming stimulus into the stock market. Because if they're employed, if their situation is okay, they've been business as usual, they just got a free check. Hey, why not throw it into the stock market? So what's happening? You have taxpayer dollars that are going in to the big names in the stock market, whether that's trying to get that almighty 7 shares of Amazon or whatever it happens to be. Think about that. It's essentially a bailout. This is what's happening. It's indirect, but this is essentially a bailout of the biggest companies in the world. To me, not exactly a good use of taxpayer dollars. Another thing that has been riding sky high, not just the stock market, but of course it's been real estate. You go to most major cities around the world today, and they have been flying sky high, skyrocketing right here. And this article out of Bloomberg is talking about Canada, and they just show you something that I really wanted to highlight. These are new numbers. So this is something I brought up before, but it is absolutely critical to understand why we have a bubble that has yet to burst. And the governments essentially will do whatever it takes. And this is why. Right here, you can see a record 9% of the economy is tied up in residential real estate. 9%. That is massive. That's just residential real estate. You extrapolate that and think, how many of these businesses are technically, giving you can't say directly, okay, real estate agents or the brokers or what have you. Okay, that's a person who is absolutely part of this. But look at it a bit further. If you've got a construction site and they're building a condo there, now imagine how many businesses surrounding it, the food courts and any types of services that the people working in that building for the next 2 years, 3 years, whatever it is, they're feeding off of that. So they're relying on this for the people to come by to eat at their shops and so on. So there's much more to it than just the direct impact that we're seeing here. But so the point I'm trying to make is so many jobs are focused around consistently building not just all these condos, but houses and other things, townhouses and so on. All of that is so key, so important to the economy. The health of the housing sector is quite important to some, and I would say more than quite important, to some of the bigger cities in Canada. You get in a situation where, I don't want to say it's too big to fail, but we're close to that. Any weakening in the residential market could threaten the regional economy in some of the bigger cities, and that is absolutely 100% true. And it's simply a whitewash because it would be devastating if there's even a small correction. The UK economy shrank by 10% in 2020. Economy forecast to rebound in 2021 with predicted annual growth of 4% this year. We'll actually see what happens. 700,000 people lost their jobs. Unemployment expected to peak at 6.5%, lower than the 12% previously predicted. Why? Because everything's growing and everything's fantastic. The economy's going to open up and we'll see. But if they're doing the same thing, I got to see how the calculation of the numbers in the UK works, but if they're anything like they are in the US and other places, we know it's not really a good indicator anyway. The point I'm trying to make here is that all around the world is generally following in the same patterns today. Continuing our trip around the world, Australia's central bank commits to keep 3-year yields low amid bond rout. So what do? You've got a problem. You've got an issue. You print money, no matter what it is. You just print money. Oh, you fell down, you scraped your knee, print some money, rub the money on the knee, and it's all good. Just a few notes here about what's going on in the bond market. Very important, critical to watch. I'll be doing a full download on this in the coming days. I'm sort of sitting back, waiting and seeing how it all happens. I don't like to get into something and then by the time the video comes out, it's already irrelevant because it flipped back the other way. That has happened to me before. So, I'm kind of sitting, I'm waiting, but I wanted to mention a couple quick points that are really important to be keeping an eye on. Among other things, the stimulus package is likely to go through and the economy is reopening. The battle is on between rates going high super fast and a Federal Reserve that's trying to keep the market stable and may try to slow the momentum of the reflation and economic rebound trade into something more manageable. This is generally not going to be the case. We'll see. But anyway, early inklings of inflation were evident in data from the Institute for Supply Management this week. Measures of prices paid jumped to their highest levels since 2008. Take a look at this. Decade high. U.S. inflation expectations climbed to the highest level since 2008. 5-year U.S. break-even rate. I mean, we're going higher and higher, and it doesn't seem to be stopping any time soon. Then we have this. Harder to trade. Bid-offer spreads widen in treasuries, a sign of worsening liquidity. And that goes with anything. That goes with absolutely anything, because if you look at stocks, people say, well, I'll just sell it. No problem. But there's got to be a buyer. And at what price will there be a buyer? Same with real estate. Oh, no worries. If I need the money, I'm just going to sell it. I'll sell the property. But at what price? Yeah, you can do that today. But nobody maybe wants to sell that property today. Look at some of the weaker markets. If you look at the areas that have been, let's say, really depressed because they were in the financial sector and everybody's working from home and so on, and now you wanted to sell that, well, you're going to be selling it for less than what you believe it's worth. But something only has value based on what somebody else is willing to pay for it. That is key. And then you're looking at here, and then came last week when the gap between the bid and offer prices for 30-year bonds at the widest since the panic of March 2020. The latest events are a stark reminder of what happens when liquidity suddenly vanishes in the deepest, largest bond market. Very key, and I just want to make note of that. Here's another chart that goes along with that. Hiccup Liquidity Index shows conditions worsened in the latest bond sell-off. That blue line there, that's the 10-year bond yields. By the time you're seeing this, who knows where it is, but I mean, it is clearly moving up, as you can see, and that's just showing you that the Federal Reserve is saying one thing, we're paying attention to it, but ultimately they're really worried because the bond market doesn't care what the Federal Reserve says, only the actions they take, and they just keep moving, and we're going to keep an eye on it, but this is obviously freaking out some people in the investment community. Bonds the trigger, stock market swoons come amid periods of bond volatility. We did see this, of course, right at the bottom there back in March 2020. We saw it again a few months later. Now we're looking at it today, and nobody really knows what's going to come, of course, but there's a lot of weakness on many different levels. And what the market is looking for ultimately is printing more money, but they'll take a $1.9 trillion stimulus. Why not? That's all for this video. If you found it informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. If you want to learn about e-commerce, you can do so for free at the AmazonGPS.com. If you want to get some information about the financial system, how it all works, central banks, and so on, all of that is detailed in my 2 books. You can check out the link in the description. And if you haven't seen this video yet, you've got to check it out. Click it, and I'll see you there.